January 8th, 2026. A single day that changed everything, while the world celebrated silver crossing $30, while traders high-fived over green candles. Something happened in the shadows of the CME clearinghouse, something so abnormal, so technically catastrophic, that most modern investors have never witnessed it in their entire careers. 1,624 institutional entities abandoned logic, abandoned standard procedure, and did the unthinkable. They moved backward. They paid premiums they didn't need to pay. They took on costs they could have avoided. They demanded immediate physical delivery in a non-delivery month. Why? What do they know that you don't? Welcome to Currency Archive, where we preserve the financial truths that others choose to forget. If you've built a business over the past 3 decades, if you've weathered recessions, market crashes, and currency devaluations, if you understand that real wealth isn't built on hype, but on knowledge, then you're exactly where you need to be. I'd like to ask you a favor, the kind you'd ask a trusted colleague over coffee. Hit that subscribe button, not because we need the numbers, but because economic warnings like this one need to reach people who actually understand what's at stake, people like you. And before we continue, drop a comment below and tell us, where in the world are you watching this from? Are you in New York, London, Singapore, Mumbai? Because what's happening in the silver market right now crosses every border, impacts every currency, and demands the attention of every serious business mind on this planet. Now, let's uncover what 1,624 institutional players know that the financial media is deliberately hiding from you. The date was January 8th, 2026, a Thursday that appeared ordinary on the surface, but concealed an earthquake beneath. At 1:30 p.m. Eastern Standard Time, the CME Group released its daily clearing report for silver futures. Most traders barely glanced at it. They were too busy celebrating. Silver had closed at 30.17, up a remarkable 4.6% in a single trading session. Green candles dominated every chart, social media erupted with bullish predictions, and the comment sections overflowed with excitement about the breakout everyone had been waiting for. But buried in page 47 of that technical clearing report, in a column that most people never read, sat a number that made a handful of analysts stop breathing. 1,624 contracts. To understand why this number matters, one must first understand how the silver futures market is supposed to work. The COMEX silver market operates on a simple principle. Traders buy and sell contracts, each representing 5,000 ounces of physical silver. But here's the critical detail. Most of these traders never want the actual metal. They are speculators. They want price exposure, not armored trucks backing up to their warehouse. So as a contract approaches its expiration date, traders execute what's called a roll forward. They sell their expiring contract, let's say January, and simultaneously buy a contract in a future month, like March or May. This is normal. This is how the system is designed to function. Time flows in one direction, and positions roll with it, moving steadily forward into the future. January expires. Traders move to March. March expires. Traders move to May. The river flows downstream, always downstream. But on January 8th, 2026, something unprecedented occurred. The river reversed. 1,624 entities, sophisticated institutional players with access to the best market intelligence money can buy, did the exact opposite of what logic dictates. They abandoned their March contracts. They moved backward in time. They rolled into the expiring January contract and stood for immediate physical delivery. This represented 8.12 million ounces of physical silver. To put that in perspective, that's $245 million worth of metal demanded for immediate settlement in what the COMEX calendar classifies as a non-delivery month. Now, the business-minded viewer must ask a critical question. Why? Why would an institution willingly pay the spread penalty? Why would they absorb the transaction costs? Why would they take on the logistical nightmare of immediate physical settlement when they could simply wait 60 days and take delivery in March with far less friction? The answer cannot be found in optimism. It cannot be explained by bullish sentiment. The entities executing backward rolls were not celebrating the $30 silver price. They were running from something. Let's examine what these 1,224 contracts actually represent. Each contract equals 5,000 ounces. So we're discussing 8.12 million ounces of immediate physical demand. But the real significance emerges when we compare this to historical patterns. In a typical January, which is classified as a non-delivery month on the COMEX calendar, the exchange process is approximately 400 to 500 delivery contracts. This is considered normal activity. Mostly commercial hedgers and small-scale industrial users taking modest positions. But 1,124 contracts? That represents a 324% increase over normal January delivery activity. This isn't a trend. This is an anomaly. And in financial markets, anomalies of this magnitude don't occur randomly. They signal something fundamental breaking beneath the surface. To understand the gravity, one must consider what backward rolling actually costs. When a trader rolls forward from January to March, they typically pay a small premium called contango. This is normal. This is expected. This is the cost of extending exposure into the future. But when a trader rolls backward, they pay a much steeper price. They lose the contango premium they could have earned. They pay wider bid-ask spreads because liquidity in expiring contracts is thinner. They absorb administrative costs associated with early delivery logistics. They commit capital immediately rather than 2 months from now. And perhaps most critically, they accept delivery during a month when vault operations are less prepared to handle large-scale physical settlements. Every single one of these costs is avoidable, simply by waiting. Yet 1,724 institutional entities chose to pay them anyway. The only rational explanation is fear, not market fear, not sentiment fear, but structural fear. These institutions looked at the March delivery window and concluded that waiting 60 days introduced unacceptable risk. What risk? The risk that the metal won't be there, the risk that a paper promise today becomes a worthless IOU tomorrow, the risk that the vault empties before their turn arrives. This is not speculation. This is data. And the data is screaming a warning that most investors are too distracted by price action to hear. The $30 silver price tells us that demand is strong, but when the 624 backward rolls tell us something far more urgent. They tell us that trust is dying. There's a concept in economics that rarely gets discussed in mainstream financial media. It's called counterparty confidence. And on January 8th, 2026, it quietly died in the silver market. Let's step back from the numbers for a moment and examine what a futures contract actually represents. At its core, a futures contract is nothing more than a promise, a legal agreement between two parties. One party promises to deliver physical metal at a future date. The other party promises to pay the agreed price when that date arrives. For decades, this system worked beautifully. Industrial manufacturers could lock in their silver costs months in advance. Mining companies could guarantee revenue before ore even left the ground. Speculators could gain price exposure without the headache of storing physical metal. Everyone won. But this entire elegant system rests on a single fragile foundation: trust. Trust that when March arrives and a contract holder demands delivery, the vault will open and 5,000 ounces of physical silver will be waiting. Trust that paper promises convert seamlessly into tangible metal. Trust that the COMEX exchange has properly managed its inventory, maintained adequate registered stocks, and honored its fundamental obligation as a clearinghouse. On January 8th, that trust shattered. And we know this because of who was doing the backward rolling. The 1,624 contracts demanding immediate delivery weren't retail investors panic buying on Reddit forums. They weren't YouTube enthusiasts caught up in silver squeeze fantasies. These were institutional players, solar panel manufacturers who need silver for photovoltaic cell production, battery technology companies integrating silver into next-generation energy storage systems, electronics conglomerates with multi-billion-dollar supply chains dependent on consistent silver availability, sovereign wealth funds managing national reserves for countries nervous about dollar stability, large-scale bullion dealers arbitraging at physical premiums between continents. These are entities with dedicated commodities teams, risk management departments with PhD economists, direct access to COMEX vault managers, and clearing data that retail investors never see. They are not emotional. They are not impulsive. They are calculating, methodical, and ruthlessly focused on protecting their operational interests. So when 1,624 of these sophisticated entities simultaneously abandon normal procedure and demand immediate physical delivery at significant cost, they are sending a signal, a very specific, very alarming signal. They have stopped believing that March delivery is guaranteed. But why? What shifted in their analysis between December 2025 and January 2026? The answer lies in three converging factors that most investors haven't connected yet. First, Chinese export restrictions. In late 2025, China implemented sweeping controls on strategic metal exports, including silver. Executive Order 14346 in the United States attempted to counter this, but the damage was already done. China produces approximately 3,600 metric tons of silver annually, roughly 115 million ounces. When Beijing restricts exports, that metal doesn't just disappear. It stays in China. It gets allocated to domestic manufacturers, Chinese electronics companies, Chinese solar producers, Chinese battery makers. And suddenly, the global tradable supply contracts by 18 to 22 million ounces annually. That metal is gone from the COMEX system. Second, vault inventory deterioration. Between October 2025 and January 2026, COMEX registered silver inventory declined by 23%. Registered inventory is the critical metric. It represents silver that is specifically allocated and available for delivery against futures contracts. 3 months ago, registered stocks stood at approximately 61 million ounces. By early January 2026, that number had fallen to 47 million ounces. Now, do the mathematics. 1,624 contracts equal 8.12 million ounces. And that's 17.3% of total registered inventory demanded in a single day. If this delivery demand continues for just 5 more trading sessions, the entire registered vault would be theoretically emptied. Obviously, new metal flows in, contracts get rolled, the system is dynamic, but the ratio is what matters. When daily delivery demand starts consuming double-digit percentages of available registered stock, institutional risk managers notice, and they act. Third, the Shanghai premium. For most of 2024 and early 2025, silver prices in Shanghai and New York traded within $1 to $2 of each other. This is normal. Arbitrage traders keep global prices aligned, moving metal from low-price regions to high-price regions, pocketing the spread. But by December 2025, something broke. The Shanghai silver premium over New York spot exploded to $8 per ounce. By early January 2026, it widened further to $10 to $12 per ounce. This is not normal. This indicates a physical dislocation. Chinese buyers are so desperate for immediate metal that they will pay $12 more per ounce than Americans, just to secure delivery now. And here's the critical insight. If Shanghai traders are paying $12 premiums for immediate delivery, that metal is flowing east. It's leaving COMEX vaults. It's being shipped to Asia, and it's not coming back. So when institutional players in New York looked at this data, they reached an inevitable conclusion. Waiting for March delivery means competing with Chinese demand, with diminished vault inventory, with export restrictions choking supply, and with premium signaling extreme physical tightness. Waiting introduces risk, unacceptable risk. So they paid the penalties, absorbed the costs, and grabbed the metal while it was still available. This is not bullish sentiment. This is institutional panic dressed in sophisticated financial engineering. The backward rolling of 1,624 contracts is not a bet on higher prices. It's a bet that the system itself is failing. And when institutions bet against the system, the business community should pay very close attention, because the next domino is already tipping. There is a concept in resource economics that separates amateurs from professionals. It's called elasticity of supply. And in the silver market, that elasticity just snapped. Most investors focus obsessively on demand. They count solar panels being installed. They track electric vehicle production numbers. They monitor industrial fabrication reports. Demand is exciting. Demand is tangible. Demand makes for compelling headlines. But the professionals, the ones backward rolling plastic 1,624 contracts, aren't looking at demand. They're looking at something far more critical. Where does the metal actually come from? And more importantly, what happens when it stops coming? Let's examine the global silver supply chain with the precision it demands. In 2025, global mine production totaled approximately 822 million ounces. That's every silver mine on Earth, operating at full capacity for 365 days. But here's the detail most analysts miss. Only 28% of that silver came from primary silver mines. The remaining 72%, roughly 592 million ounces, came as a byproduct. Silver extracted alongside copper, lead, zinc, and gold. This creates a unique vulnerability. And when copper prices fall, copper mines slow production. When lead demand weakens, lead mines cut output. And when those base metal mines reduce operations, silver production falls. Regardless of silver's own price, the silver market doesn't control its own supply destiny. It's a passenger in someone else's vehicle. Now let's examine the 4 countries that dominate global production. Mexico produces 189 million ounces annually. Peru produces 95 million ounces. China produces 115 million ounces. Australia produces 46 million ounces. Together, these 4 nations represent 73% of world production. But in late 2025, 2 of these countries implemented policies that fundamentally altered global supply dynamics. China, as discussed earlier, restricted exports. 115 million ounces of annual production, suddenly unavailable to Western markets. Mexico, facing domestic currency pressures, imposed a 15% export tax on refined silver in November 2025. This didn't stop Mexican exports, but it did make them significantly more expensive. The global tradable supply, the silver actually available for purchase by non-Chinese entities, contracted by approximately 18 to 22%. In a market already running structural deficits, this was catastrophic. But the supply story gets worse, because we must examine the other side of the equation, industrial demand. The The Silver Institute's 2025 report projected total industrial fabrication at 537 million ounces. Let's break that down by sector. Solar photovoltaic production consumed 165 million ounces. Every solar panel requires silver paste for electrical conductivity. There is no substitute material that matches silver's efficiency at current price points, and global solar installation capacity is expanding, not contracting. The International Energy Agency projects 25% year-over-year growth in solar deployment through 2027. That means silver demand from this sector alone could reach 206 million ounces by 2027. Electronics and 5G infrastructure consumed 78 million ounces. Smartphones, computers, telecommunications equipment, automotive electronics all require silver for circuitry and conductivity. The rollout of 5G networks globally represents millions of new base stations, each containing silver components. This demand is structural, not cyclical. Electric vehicle battery systems consumed 12 million ounces in 2025. This is the emerging category that most analysts underestimate. Silver zinc batteries, silver oxide batteries, and silver-based thermal management systems are becoming standard in premium EV platforms. Current adoption rates suggest this could reach 35 to 40 million ounces annually by 2028. Medical and biocidal applications consumed 35 million ounces. Silver's antimicrobial properties make it irreplaceable in wound dressings, surgical instruments, and hospital surface coatings. Post-pandemic awareness of infection control has permanently elevated this demand category. Add these sectors together, and we arrive at 537 million ounces of industrial fabrication demand. But remember, global mine production is only 822 million ounces, and that's before we account for investment demand, physical coins and bars, ETF holdings, sovereign reserves, institutional accumulation. The World Silver Survey estimated investment demand at 247 million ounces in 2025. So let's do the mathematics. Total demand, 537 million dry industrial, plus 247 million investment, dry 784 million ounces. Total supply, 822 million ounces from mining, plus approximately 180 million ounces from recycling, 12 million ounces. On the surface, that looks like a surplus of 218 million ounces. But this is where the amateur analysis ends and professional analysis begins, because those numbers assume everything remains constant. They assume China doesn't restrict exports. They assume Mexican tax policy doesn't change. They assume base metal prices stay high enough to keep byproduct silver flowing. They assume recycling economics remain viable, even though recycling only becomes profitable above $35 to $40 silver. Remove just one of those assumptions, and the surplus evaporates. Remove two, and you have a deficit. The Silver Institute's adjusted 2025 projection, accounting for Chinese restrictions and Mexican policy changes, showed an actual deficit of 142 million ounces, not a surplus, a deficit. That means humanity consumed 142 million more ounces than it produced. Where did those 142 million ounces come from? Above-ground stockpiles, vaults, reserves, inventory that took decades to accumulate, being drawn down at 142 million ounces per year. Industry experts estimate total available for sale above-ground silver stocks at approximately 1.2 to 1.7 billion ounces. At a deficit rate of 142 million ounces annually, those stockpiles last 8 to 12 years. But here's the critical insight that triggered the backward rolling phenomenon. Those institutional players executing 1,724 immediate delivery contracts, they weren't worried about 8 years from now. They were worried about 8 weeks from now. Because while total above-ground stocks might be 1.2 billion ounces, the amount sitting in COMEX registered vaults, available for immediate delivery against futures contracts, was only 47 million ounces, and it was declining rapidly. So those institutions looked at the data, ran the projections, and reached a terrifying conclusion. The global supply situation might be manageable over a decade, but the COMEX vault situation is critical right now. And when sophisticated players see a structural supply crisis, they don't wait for confirmation. They act immediately. There's a moment in every market cycle that separates wealth builders from wealth observers. It's the moment when data stops being theoretical and becomes inevitable. January 8th, 2026 was that moment for silver. The backward rolling of 1,624 contracts didn't predict the future. It revealed the future that institutional players had already accepted as certain. And now, the only question remaining is not if silver reaches $100, the question is when and how fast. Let's construct the pathway with the precision this analysis demands. Silver closed at $30.17 on January 9th, 2026. To reach $100, the metal must appreciate 232% from current levels. For context, Silver achieved a 442% gain between 2008 and 2011, moving from $9 to $49 in under 3 years. So a 232% move is not unprecedented. It's actually modest by historical silver volatility standards. But unlike the 2008-2011 rally, which was driven primarily by monetary inflation fears and speculative excess, this move will be driven by something far more powerful: physical scarcity. And physical scarcity, once established, doesn't reverse quickly. The pathway to $100 silver operates on 3 distinct phases, each phase triggered by specific market mechanics, each phase amplifying the next. Phase 1, premium expansion, current Q2 2026. Target range $30 to $48. This phase is already underway. It begins with the Shanghai premium widening beyond $12 per ounce. When Asian buyers consistently pay $12 more than New York spot, arbitrage economics force COMEX prices higher. Physical metal flows to the highest bidder. If Shanghai is bidding $42 and New York is offering $30, the metal ships east. COMEX vaults drain. Registered inventory continues its 23% quarterly decline, and eventually, New York spot prices must rise to stem the outflow. Industry analysts project the Shanghai premium could widen to $15 to $18 per ounce by March 2026. If that occurs, COMEX spot silver would need to reach $42 to $45 just to maintain global price equilibrium. This isn't speculation. This is arbitrage mathematics. The backward rolling phenomenon accelerates this phase. Every institutional entity demanding immediate delivery removes metal from available supply. Fewer ounces in the vault means higher premiums for remaining inventory. Higher premiums mean higher spot prices. Probability assessment: 75% chance silver reaches $42 to $48 by Q2 2026. Phase 2, industrial panic procurement, Q2, Q3 2026. Target range $48 to $75. This is where the market transitions from tight to crisis. In Phase 1, sophisticated institutional players are positioning quietly. They're the ones backward rolling contracts. They understand the data. They see the deficit. They act preemptively. But Phase 2 begins when the broader industrial community wakes up. When solar manufacturers in Germany realize their April silver shipments are delayed. When electronics companies in Taiwan discover their suppliers can't guarantee Q3 delivery. When battery producers in South Korea face force majeure notifications from refiners, this is when procurement departments panic. And panic procurement doesn't care about price. It cares about availability. A solar manufacturer with a $2 billion construction contract can't tell their client, "Sorry, we couldn't get silver, so your project is delayed 6 months." They'll pay $60, $70, even $80 per ounce, if that's what secures delivery. Now consider the scale. Industrial fabrication demand, 537 million ounces annually. If just 10% of industrial users shift from normal procurement cycles to immediate physical buying, that's 53.7 million ounces of additional spot demand. But remember, COMEX registered inventory is only 47 million ounces. The mathematics doesn't work. There isn't enough immediately available metal to satisfy panic procurement. So price must rise sharply to ration the available supply. This is classic supply-demand economics, but accelerated, compressed, violent. Historical precedent exists. In 2011, when silver moved from $26 to $49 in just 109 days, it wasn't gradual. It was a parabolic spike driven by physical tightness and momentum buying. This time, the physical tightness is structurally worse, and the industrial dependence on silver is significantly higher than 2011. Probability assessment: 55% chance silver reaches $65 to $75 by Q3 2026. Phase 3, speculative capital influx, Q3 2026, Q1 2027. Target range, $75 to 100 plus. This is the phase where silver transitions from industrial crisis to mainstream financial phenomenon. When CNBC runs breaking news segments on silver shortages, when Bloomberg features silver analysts every morning, when retail investors, pension funds, and hedge funds suddenly realize, wait, there's an actual supply crisis happening. Speculative capital operates differently than industrial procurement. Industrial buyers need specific quantities for specific production schedules, but speculative capital has no upper limit. If silver is genuinely scarce, if the deficit is real, if $100 is inevitable, then hedge funds with billions in assets under management start allocating. Commodity ETFs see massive inflows. Retail investors rush to secure physical coins and bars, and suddenly, the 247 million ounces of annual investment demand doubles or triples. The silver to gold ratio provides mathematical support for this phase. Historically, silver trades at a 160 to 180 ratio to gold. Currently, that ratio sits at approximately 194. If gold maintains its current price near $2,950 per ounce, a return to the 1:75 ratio implies silver at $38. A return to the 160 ratio implies silver at $47.50. But if industrial panic procurement has already pushed silver to $65 to $75, and speculative capital floods in seeking mean reversion to historical ratios, the mathematics extends beyond traditional boundaries. Gold itself could rally on monetary concerns, reaching $3,500 to $4,000. At a 160 ratio, that implies silver at $58 to $66. But ratios are historical averages, not ceilings. In crisis conditions, silver historically outperforms gold on a percentage basis. The 2011 peak saw silver briefly trade at a 132 ratio. If that dynamic repeats, with gold at $3,500, silver reaches $109. Probability assessment: 35% chance silver reaches 100 plus by Q1 2027. Strategic positioning for business. Decision makers. The backward rolling of 1,724 contracts provides a clear signal. Institutional players are positioning now, not waiting for confirmation. For industrial end users dependent on silver inputs, the strategic imperative is immediate. Secure 6 to 12 months of physical inventory at current prices. Implement cost-averaging procurement for forward needs. Model profit margins under $50, $75, and $100 silver scenarios. Identify which competitors are most vulnerable to input cost spikes. For investors and wealth managers, physical allocation becomes prudent. 5% to 15% of liquid assets in allocated silver storage. Avoid leveraged futures exposure. Counterparty risk is elevated in tight physical markets. Monitor COMEX registered inventory weekly. If it falls below 35 million ounces, phase 2 is imminent. For entrepreneurs and strategic planners, this is not simply a commodity trade. This is a structural market transition. Businesses that adapt early gain competitive advantage. Those that wait for mainstream confirmation face margin compression and supply disruption. The 1,624 contracts weren't a prediction, they were a decision. A decision by the most informed players in the market. That waiting is more dangerous than acting. The pathway to $100 silver is not guaranteed. Markets are dynamic. Variables change. Black swans appear. But the structural conditions are in place. The deficit is real. The inventory is declining. The industrial dependence is absolute, and the institutions have already voted with their capital. They've backward rolled into immediate delivery. They've paid the premiums. They've accepted the costs because they've calculated the alternative. And the alternative is being the one left without metal when the vault empties. The stadium isn't just burning, the exits are narrowing. And when us now 224 institutional players just walked through the door. The question business leaders must answer is simple. Are you following them, or are you waiting to see what happens next?